Hi, guys. Welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. Top ways to earn money besides putting it in a savings accounts. So make sure to watch the full video. 1. Online savings. A few years ago no one would have considered this option. Online banks would have been considered too risky. Also, today most banks offer online banking. So what makes online banks different? Because they operate strictly online, they don't have branches all over the country, nor the overhead costs and payrolls of brick-and-mortar banks. With lower operating expenses, they're able to pay much higher interest rates on deposits. And now that they've been around for a few years, online banks are becoming much more accepted by the public. Why should you hold your money in an online bank? Because rates aren't just higher than local banks, they're much higher. For example, Ally Bank, CIT Bank and Synchrony Bank all currently offer their online high-yield savings accounts paying rates of 2% or more. And even though online banks operate entirely on the internet, they're still completely liquid. You can move money in and out of them, to and from other banks, and even access your funds at a network ATM. Do a bit of a background check on any online bank you're considering moving your money to. Find out how long the bank has been around, and make sure they have FDIC coverage. You can certainly keep your local bank for checking and loans, but you'll earn a lot more money by moving at least most of your savings to an online bank. And if you want to tie up your money for a little bit longer to earn more interest, check out the rates online banks offer on certificates of deposit, CDs. They're also much higher than what your local bank is paying. 2. U.S. Treasury securities. Not only do these securities pay a lot more in interest than local banks, but they're considered the safest investments on the planet. U.S. Treasury securities represent debt issued by the U.S. government, and both the principal and interest are fully guaranteed. There are different kinds of U.S. Treasury securities that depend mostly on the term of the instrument. For example, securities with maturities between 2 years and 10 years are considered Treasury notes, while maturities of 20 and 30 years are called Treasury bonds. But you'll be mostly interested in Treasury bills. These are short-term securities, ranging from 1 month to 1 year. They're not quite as liquid as a savings account or money market at your local bank, but they're very short-term in nature, and pay a lot more in interest. And if need be, you can sell them before their maturity dates. Recent yields on Treasury bills range between 2.36% for 1 month, to 2.70% for 1 year. And in addition to high yields, Treasury securities come with a bonus feature. The interest they pay is exempt from state income tax. You can get slightly higher rates on longer-term securities. But the extra interest isn't worth tying up your money for anywhere from 2 to 30 years. You can buy, hold and sell Treasury securities through Treasury Direct. 3. High dividend stocks. Here we're getting into a way to invest your money for higher yields that does involve risk. Even though they pay high dividend stocks can still fall in value. You won't want to hold emergency fund money in these stocks. But you might put a certain amount of your savings into them to increase your overall savings yield. For example, high dividend stocks often yield 3% to 4%, and some pay a lot more. There's even a group of elite high dividend stocks referred to as dividend aristocrats. The criteria for a stock to be a dividend aristocrat includes: be in the S&P 500. Meet certain minimum size and liquidity requirements. Have at least 25 years of consecutive dividend increases. 4. Bonds. Bonds are longer-term securities that pay higher interest than savings accounts. But it's important to understand bonds aren't completely safe either. Much like stocks, they can fluctuate in value. That's why if you're going to own bonds, you're better off avoiding individual issues. The better way is to invest in bond funds through exchange-traded funds, ETFs, that are tied to indexes. You'll get a portfolio of professionally managed bonds, which greatly lowers the risk of any single bond issue defaulting. There are 2 types of bond funds I like to focus on: high-yield bonds and municipal bonds. Rates on corporate bonds haven't been great in recent years. But high-yield bond funds hold portfolios of issues that pay higher yields, due to the issuing companies being considered higher risk. But they can provide high returns on short-term investments. 5. Blended portfolio. This is a more innovative strategy for getting a higher return on your savings. You can create a blended portfolio of stocks and bonds, but mostly bonds. The idea is to take advantage of the relative safety of bonds, while mixing in the higher yields provided by stocks. For example, you might create a portfolio that's 80% bonds and 20% stocks. Or even 75% bonds and 25% stocks if you want to be a little bit more aggressive. This portfolio is more risky than CDs or Treasury securities, but it does have the potential to provide higher returns. Not only will you get the interest income on the bond portion, but you can also take advantage of capital appreciation on the stocks. It'll raise your overall return at least a little bit above what you would get on interest-only investments. Robo-advisors normally evaluate your investor profile based on your investment goals, time horizon, and risk tolerance. You can set a very high bond allocation by entering a short time horizon. For example, if that horizon is 3 years, your portfolio will automatically be mostly invested in bonds. 6. Real estate investment trusts. If you prefer to avoid stocks and bonds, you can also invest in real estate. You can do this through real estate investment trusts, which are commonly known as REITs. REITs are investment trusts that invest in real estate. They're sort of like mutual funds for real estate. Most typically, they invest in commercial real estate, like office buildings, retail space, and large apartment complexes. But some work on smaller projects, like property rehabs. Still others track major industry indexes. The easiest way to diversify across several different REITs is through an ETF. For example, the iShares Core US REIT ETF has a current distribution yield of 10.64% and invests in more than 160 individual REITs. Still another way to invest in real estate is through online crowdfunding platforms. This is where you can invest money in either loans or equity positions in particular real estate deals. There are several crowdfunding platforms, including Fundrise, Realty Mogul, and Rich Uncles. 7. Peer-to-peer. Peer-to-peer lending. This is a totally unique way of investing in fixed income assets. Peer-to-peer lending platforms enable you to invest money in loans taken by borrowers. The basic purpose of peer-to-peer lending is to remove the banker from the loan arrangement. Instead, you as the investor become the banker. Your investment is in loans made to individual borrowers. Now that's not nearly as risky as it sounds. You don't actually fund an entire loan to a borrower. Instead, you invest in what are known as notes. These are $25 units of a loan. A person who borrows $25,000 from a peer-to-peer platform may have his loan funded by up to 1,000 investors, at $25 each. This lowers the risk any investor has in a single loan. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go.